For the major record labels and their executives, it's not enough to just have a good quarter or a good year. No, your success is evaluated compared to the other peers in the industry, market share. That's the name of the game. And for an industry that talks so much about growing the pie, why are we still focused in this? So I did the math. 1 point in market share, 1 percentage point, is worth around $30 million in EBITDA. But if that 1 percentage point costs a major record label around $150 million to $200 million in budget just to maintain year after year, is it worth it? But that still doesn't mean there aren't issues. That mentality of trying to beat the peers and trying to maintain your edge can lead to overspending. I'd argue that the opportunity cost of what the money could be spent on is higher. A lot of those are seen as improvements on the underlying system, but the change would be so disruptive that the markets, the leadership, and the overall industry would not buy in. So for better or worse, it is the backbone of the system. If there's one metric that is arguably one of the most important for the major record labels and their executives, it's market share. It's not enough to just have a good quarter or a good year, the business continues to grow and have some healthy margins. No. Your success is evaluated compared to the other peers in the industry, whether it's the other major record labels or the indies that are rising as well. If your label jumps up a couple spots in market share, gains a few percentage points, you have a bit more juice. Maybe you get a bit more leeway that can help the executive not just with their own compensation, but with the next job opportunity. But if the reverse happens, your label starts losing a few percentage points in its market share, that drop is noticeable, then there may be some leadership turnover there before you know it. That's the name of the game, and that name of the game has been ingrained in this industry for decades. And I'm not going to hold you. When I first dug into this and started to hear more from the people on the ground about how this really works, how it shapes their behavior, I was a bit skeptical. This is a zero-sum game. And for an industry that talks so much about growing the pie, trying to find ways to expand, comparing itself to other sectors, which frankly don't have similar type of zero-sum games, why are we still focused in this? Is this holding the industry back from greater sights that it could have, especially when the industry spends billions of dollars annually on marketing and A&R, not just for the business and labels, but to maintain and hopefully grow this same market share that we're talking about? So I did the math, had to run some numbers on this. 1 point in market share, 1 percentage point, is worth around $30 million in EBITDA. That's not insignificant, that's huge. But if that 1 percentage point costs a major record label around $150 million to $200 million in budget just to maintain year after year, is it worth it? Could the money be used for other things? I dug into this for a few reasons. First, there are tons of people that I talk to that operate outside of music. They're often perplexed by some of the industry-specific things, and this is one of them that they think can hold the industry back. But on the other side, I know plenty of people that work and lead and are in these same positions at their companies, smart, talented people, and there's plenty of things that from the outside people may not get if they're not really in the weeds, so I had to dig in. And I will say that there's a bit more nuance with this where some things do make sense, but there are others that are worth challenging. One important piece here is executive compensation. The heads of the major record label groups and the individual labels themselves are compensated not just in base salary, not just in equity, but in performance stock units, restricted stock units, and performance stock options. Each of these are tied to performance, which is directly related to market share. And for better or worse, the perception of market share, even if it operates from a different time frame than the actual free cash flow that sits in a business, is an important piece of how they're evaluated. Each of these major record label groups and the underlying labels make an overwhelming majority of their money through streaming. That streaming revenue largely comes from companies like Spotify, Apple Music, YouTube, and others, and all of those companies have agreements which involve negotiations with each of the major record label groups. So if there is a drop in percentage in market share, specifically with the major record label groups amongst each other, or even with the independent groups, that hurts their negotiating power for the advances or any of the terms that they have with the major record label groups. So it does tie back into the compensation that those executives have. Plus, it's one of the clear, transparent ways in order to tie their compensation to their performance. Because even though the three major record label groups do operate as public entities, they're really not, except for Universal Music Group. Sony Music Group sits under Sony, the Japanese electronics company. Warner Music Group is a publicly traded company, but 70% of the stock and a majority control of the voting rights are controlled by Len Blavatnik and Access Industries, which leaves Universal Music Group as being one of the more traditional publicly traded companies in the space. So this is not a situation like a Mark Zuckerberg at Meta or even a Daniel Ek at Spotify, where they have both a high percentage of ownership in the companies that they are the founders of and also have a high percentage of the voting rights themselves. And given the performance-based bonuses, not just for the top executives, but for their teams, a lot of those cash pools get divvied up based on the market share. There's a black box of streaming where revenue may be collected, but there may be some confusion in terms of an artist being mislabeled, and that revenue still needs to go somewhere. Market share helps determine how that pie gets divvied up as well, and there are billions of dollars that sit in those black boxes. So all of these things factor in, and they factor in more than ever, especially on the music streaming platform and the record label side, specifically with their negotiations, because companies like Spotify and YouTube, frankly, have only become stronger in recent years. Spotify's stock is trading at a price now that is 10 times higher than it was in November 2022. The major record label groups and most music content-related companies that actually own the underlying IP have not increased in that same type of way in that time frame. YouTube, based on analyst estimates, is worth nearly $500 billion. So that's a huge entity of itself, even though it's technically still under Alphabet. So even the optics of the major labels potentially losing more and more of their market share to the independents, that plays a huge role in that. And market share is one of the ways that they are able to help defend that. One of the critiques I've often wondered about market share is that, does it lead to overspending? Does it lead to executives, because of the incentives that they have, to be spending more on trying to make a big hit record work or trying to sign new artists in some type of way? And some of this is inherently true. This is a power law driven industry. By nature, there is a bit of a negative working capital mentality where everyone is banking on the future. Everyone is trying to invest and frankly over-investing, because if there is one big hit that may break through, then that might be the next Taylor Swift. That might be the next Drake. Obviously, you and I have talked enough about why I think that may be too high of a ceiling to expect an artist that is breaking out now in this era. But even if you want to have someone become the next Sabrina Carpenter, the next Chappell Roan, the next Doechii, the next Big X the Plug, you name it, that still takes a lot of work to be able to make happen. But for those bets to pay off, there needs to be some capital put into them. So it does lead to some natural tension where some of that may sit at odds with how a business, independent of worrying about market share, may operate naturally. And I think this point is especially critical now because we've heard many of the major record label heads talk about how much more expensive it is to sign artists in today's age, when artists have more optionality than ever. It's harder to discover than it was in the earlier days of the internet, and all of these things can compound, especially when the ceiling becomes lower in terms of what may seem like is possible. It makes me think a lot about the NBA, where the amount of money and the amount of assets that teams are willing to trade to try to level up feels like it's increased tenfold. But if everyone is overspending to try to get that one, to try to take advantage of this opportunity, it's hard to blame them when that's the market. I look at a trade that happened recently in the NBA where the Memphis Grizzlies and Orlando Magic just had a trade. The Orlando Magic traded 4 first-round picks plus 2 veterans and a pick swap for Desmond Bane. Desmond Bane is great. He's put up good numbers for the Memphis Grizzlies, but to keep it a buck, this is a player that has not made an All-NBA team or an All-Star team or played in the conference finals or an NBA finals game. But this is the stakes of where things are, especially if you're a small market team like the Orlando Magic that's trying to level up. For a lot of these record labels that aren't Interscope, that aren't Atlantic, that aren't Warner Records, that aren't Republic, they feel like they have to make some of these same moves too to be able to get there. So all of that is understandable, just given the dynamics and how entrenched that is. But that still doesn't mean there aren't issues. First off, as we discussed, that mentality of trying to beat the peers and trying to maintain your edge can lead to overspending at the sake of the own health of the underlying business. So all of the things that go into spend, whether it's higher advances, more marketing, it can lead to unrecouped advances, which then, to be fair, are things that count against the efficiency, which is one of the metrics that the executives are evaluated on. So a lot of this stuff does come back around and does need to be taken account of in some shape or form. It reminds me of how a lot of venture-backed startups can operate. Sure, profitability may be the goal, but there's still that mentality. There's still that focus of trying to grow at all costs, not necessarily thinking about what is best for you and your customers and being able to run a healthy business today, but what can help you get to that next level to build there and grow for the future. But again, these are not venture-backed startups. These are established companies. But I'd argue that the opportunity cost of what the money could be spent on is higher. What if the money that wasn't used to pump out that 8-figure advance or to pump out that additional marketing spend could be used to acquire a catalog from an artist that's proven, or to make a bet on something that is R&D related, especially if it can help with monetizing the underlying product of music better, which is one of the goals that the industry has. If you're trying to grow the pie, it's probably going to take some more investment beyond just operating within the current mechanisms of what exists today. But listen, I am not going to make it seem like I am the first person, because I'm definitely not, nor am I the last person to make the case for this. Because like most industries, when there's something this entrenched, a change to the system would be so disruptive that the markets, the leadership, and the overall industry would not buy in and would likely see any change in disruption purely a spin. If you're a major record label head or someone that's leading a major record label group, and you choose not to spend the way that others would spend on market share, and your numbers start to dip, Wall Street then reacts quicker to your numbers dipping before you can even try to make the case or have the patience of time frame to say, well, whoa, just wait, we're going to invest in this instead, we're not going to do this. That's a surefire way to lose. One of the classic examples of not trying to disrupt the ship, even though the current model is imperfect and there could be a better one, but we don't want to explore that, is how streaming payouts work overall. The pro rata model, which pools all of the money that you and I and others pay for streaming and all the advertising revenue as well, and then distributes that on an aggregate basis based on overall listening. A lot of people have issues with it. Some of the record labels want to push towards artist-centric, user-centric. SoundCloud has their fan-powered royalties. A lot of those are seen as improvements on the underlying system, but the change would be so disruptive that a lot of people aren't willing to see that happen at a grand scale. You may see it on SoundCloud, you may see it on Deezer, but you've yet to see it on some of the other platforms in the space. And this is one of the reasons why. Better will not always happen, especially if the short-term disruption could be too much to bear early on. Again, it reminds me of the NBA, where, especially after the NBA Finals, there's been a lot of talk about shortening the NBA season, shortening the NBA playoffs, because you have a lot of these young players that are having these Achilles injuries and other career-altering injuries that we normally expect for people in the twilight years of their career, but they're happening to players that are 25 years old, 27 years old. And that's why a lot of people want to make the case that, hey, shorten the season. Sure, there may be an initial hit that you as an owner takes in revenue, or you as a players in your collective bargaining agreement take in revenue, but the overall product could increase, and as a result you can get more viewers from it. Yes, that is an argument that sounds very easy to say, but convincing the owners to decrease, we've yet to see any league decrease the number of games. So again, I'm skeptical that these things could happen, not just in the NBA, but in music for a similar type of reason. And again, as we talked about, these things are so entrenched, the rewiring that would need to happen in the industry with everyone else overall, with the current contracts that are in place, there's just too much disruption that I think we probably wouldn't see it. But to be clear, I'm mostly talking about the major record labels. There are independent music companies and labels that have more of these dynamics. Companies like BMG, Empire, Hype. There's less of that market share focus, and it's a bit more directly tied to the artist, whether it's on frontline music because they aren't these massive record labels with decades of back catalog, or it's in pure differentiation, or there's a bit more of that centric ownership mentality where the person that's in the driver's seat can think both long-term and not just short-term the way that a publicly traded CEO might. Plus, a lot of the major record labels have their bargaining with the music streaming platforms handled by companies like Merlin and others, so a lot of that's taken care of for them so they can focus on other things. So if we see any improvements to the model, I expect to see it on the indie side, not as much the major label side. But again, when there are industries where there's dynamics that will happen that may seem a bit odd or unique or clearly questionable, why is it such an important thing. I think most of us have probably worked in some industry where there's probably some practice that may seem a bit unique, a bit archaic. Why do they still do it this way? But we know that it's so entrenched that it likely won't happen. And music, like any industry, has its own version of that. So for better or worse, it is the backbone of the system, and I think we'll continue to see more of it. But let's hope for the artists and others, especially as streaming revenue growth slows down and there's more questions about what the next growth phase looks like, that the cost to pursue market share doesn't hurt other opportunities from being able to take that next step and really help the business move forward.